Welcome to Casual Finance Friday. My name is Steve Higgins. It is Friday, March 14th, 2025, and I'm coming to you hot from 1934 Market Street, right here in lower downtown across the street from Coors Field, getting ready for baseball season. So excited right now. The Rockies are still undefeated, but the season starts in 3 weeks, so we'll see. Hey, with that, bringing to you the third episode of Casual Finance Fridays. That is what we call a winning streak. So I'm pretty proud to get the third episode out to you today. And today we're going to be talking about something that's simple. And I think that for a lot of people, this is going to be very basic and old news. But if you're like me and very entertained by the simple things in life, you might appreciate this. So have you ever wondered how long it's going to take for you to double your money? Now, this is a question we often get asked. Now, remember, we are a financial planning firm first. So while investing people's assets is a key component to what we do, as financial planners, we help people solve and address the complexities that come with growing wealth and diverse resources. So a lot of the goals that people have revolve around financial independence. For some people, that may mean for you retirement, but really it's the idea of how can we help people get to that aspirational place in life where the financial independence represents a day where they wake up in the morning where they don't have to necessarily go to work and be economically productive to achieve the goals and the wants and the aspirations that they have in life. So for a lot of people, that means something different. For a lot of people, it is retirement. But in the context of that, we do, like I said, manage people's investment, retirement, and other liquid assets. And so we get the question, how long would it take for my money to grow, right? So how long is it going to take for my money to double? And I'm sure you've wondered how long it would take for your money to double. Well, there's a simple trick. It's called the rule of 72. I'm going to show you how that works using the time value of money formula, which you have probably long since forgotten since math class. Okay, the time value of money formula is this. Your future value equals your present value, let's say $100, let's say $100,000, multiplied by 1 times your rate of return. Let's say, I don't know, 7.2% per year, multiplied by the amount of years, let's say 10 years. If we do that math, we come up with a number of 10 years. Okay, so what that's gonna do is double your money. 7.2% per year return will double your money in 10 years. Now there's a simpler way to get that. If you back into that and you say 72 divided by your rate of return, 7.2, that gives you 10 years, the amount of time that it will take to double your money. Let's look at it another way. Instead of using a 7.2% return, let's take a 10% return. If I say 72 divided by 10%, the answer is 7.2. So at a 10% return, it would double your money in 7 years. So let's go a little further with that. So if I have $100,000 and I invest at a 10% rate of return, I'm going to double my money in 7.2 years. So in a little over 14 years, I'm going to double it again. That's 100,000 in 7 years turns into 200,000. In 14 years turns into 400,000. In 21 years and change, it turns into 800,000. In 28 and a half years or so, it's going to turn into $1.6 million. So that's how money grows. Now imagine if you're adding to that money over time, it's going to grow substantially faster. Now, how realistic is a 10% return? Now, keep in mind, not all of your money should be invested in the stock market. Okay? We don't believe that that's the right thing to do for any of our clients. The reality is there are other financial planning elements that are important as well. Short-term emergency fund needs, income needs for 3 to 5 years for those people that are living on their assets. Other more shorter-term goals that require more predictability that really shouldn't be subject to normal market volatility. Here's the numbers behind it. Over the last 10 years, the S&P 500, just a broad measure of US stocks, the 500 largest stocks in America, has returned about 11 to 12% per year. Over the last 20 years, that return has been, call it about 9% per year. And over the last 50 years, the average annual return with dividends and dividends reinvested in the S&P 500 has averaged over 12% per year. So a 10% return with dividends reinvested over time in the S&P 500 or in stocks for that matter is not unlikely, it's not rare, and it is realistic for that money in your portfolio that should be appropriately invested in stocks. Now, what that means is you have to put up with a lot of sleepless nights to get there, right? Because the reality is while that may be normal, volatility is also very normal, okay? So we should know that the market will have a 10% correction, drop by 10% or more, almost every year. It doesn't happen every single year, but you should expect that to happen at least once in any given year. In fact, as I film this, we're about 10% off the all-time high today. Now, every one of these events has a narrative that we tend to personalize, and psychology becomes very impactful and can lead us to make the wrong decisions over time, can lead us to try and time the markets. If we do that, we are very unlikely to have those long-term averages of closer to 10%, right? So while I said the market does correct about 10% once a year, you've got to be realistic and understand that the market corrects by over 20%, maybe every 2 to 3 years. In fact, when we look at like a COVID type scenario, the market went down by 34% just about 3 weeks. If we look at 2008, 2009, the market dropped by 55%. Some indexes like the NASDAQ dropped by over 70%. 2001, 2002, that recession, following the tech bust on September 11th and all of the things that had happened, that market dropped by about 50% as well. So if we're gonna have both sides of the coin of those long-term returns of around 10%, we've got to be honest with ourselves and ask ourselves the question, can I handle what's normal? Markets are volatile. That is an inherent normal quality and characteristic that we should become very comfortable with. And the money that we have invested that appropriately should be invested in the stock market is going to be subject to that volatility, but also those 10% returns over time, right? So very, very important to understand the rule of 72. Take 72 divided by your rate of return. That's how long it's going to take your money to double, right? Think about it this way. If I leave my money, if I prioritize safety with all of my long-term money, and I'm going to earn an average of 2% in a saving account, I take 72 divided by 2. The answer is your money will double in 36 years. How much time you got and what are your aspirations? Again, thank you so much for joining me in episode 3 of Casual Finance Fridays. This has been fun. Can't wait to put out episode 4. Excited that you've stayed with us. Tell your friends, tell your family. Please don't forget to like and subscribe. It really helps us get this message out. And as I said last week, helps me fulfill my very young childhood dream of becoming a YouTube legend. There wasn't YouTube when I was a kid, but I knew it was coming. All right, thanks so much. Have a wonderful weekend, and of course, happy Friday.